Hello class, welcome back to Partnership Tax. All right, so I hope you enjoyed that discussion of the mechanics and the basics of the qualified business income deduction. So now what I like to do is just do a little introduction and talk about some of the ideas you're going to see in the planning. So remember, this provision came about as a result of the Tax Cuts and Jobs Act of 2017, TCJA of 2017. And when it first came out, there was a lot of uncertainty about certain things. Some of that has been cleared up. Some of it's still uncertain. There's lots of uncertainty still out there with respect to the qualified business income deduction, section 199A. But it's just to give you a little taste of the different things. Now, one idea is that, and you've seen this throughout the course, is that the form of business, the business entity form, makes a huge difference when it comes to the tax implications in comparison. Right? We've got C corporation, doesn't get QBID, versus S corporation versus LLC. That's usually our big three in terms of our choice of entity analysis. Our business entity planning, choice of entity analysis. We've seen earlier topics. We've talked about how partnerships versus S corps, right? There's lots of advantages of being a partnership. There's some of being an S corp as well. S corp, for example, at the time of this video, it might change in the future, have employment tax benefits. But you've seen throughout the course lots of benefits for being a partnership over an S corporation. For example, on formation, the section 351 corporation versus section 721 partnership formation and contribution rules, much more favorable for partnerships and LLCs and entities taxed as a partnership because there's no control requirement, right? It's just you just get some ownership. Also, we learned about the liabilities. Liabilities that the partnership takes on are allocated in the bases of the partners, outside bases of the partners, but in S corporation, that's not the case. We also saw in distribution, we saw the benefits of being taxed as a partnership, pretty much no gain or loss on the property, versus if you're a corporation and you've got appreciated property under section 311, whether you're C corporation or S corporation, you got to record gain, okay? You got to do that. Although partnership, that's not necessarily the case if it's a pro rata distribution, okay? Or that is not the case if it's pro rata. So when it comes to the qualified business income deduction, there are differences as well. And I'm going to talk about those in a moment in the video dealing with planning aspects. But I just want to, again, bring up how important choice of entity is. And yes, this is a partnership tax course and partnership tax topic, but you should always be considering C corporation, no QBID, right? S corporation versus LLC. So always keep that in mind. Now, a lot of the considerations of choice of entity, as I mentioned earlier in earlier topics, obviously we don't know what's going to happen in the future, right? If you are forming forming an entity and trying to decide whether it should be an LLC or S corporation, and you're trying to worry about section 351, and you don't know the future, right? We don't have a crystal ball to look into the future. Well, it just so happens I do have a crystal ball with me, so let me pull that out. Got my special magic glove, right? And here's my crystal ball. And I've got my magic wand. Let's go ahead and turn this thing on, right? Boom, on, right? Let's go ahead and see what we can see in the future, right? If we have an entity in front of us and we have a client and they want to know, hey, what should I be? Should I be an S corporation, LLC, C corporation? We go ahead and let's say we eliminate C corporation because we don't want that double taxation, okay? And we want the flow through of the character of capital items and those types of things. But we're trying to decide between S corporation, small business corporation, and LLC, taxed as a partnership. Well, because we have multiple owners. We look at our crystal ball to see in the future. Unfortunately, I don't really see anything. It's kind of hard, right? Crystal ball not working, right? Hey, hello, you there? We don't got anything like that, right? Fortunately, and the magic wand, right? This is just an illusion, right? Just a light on the end of my wand here. As you can see, I turned it off. We don't really have a crystal ball. It doesn't work. Crystal ball does not actually work. So just keep that in mind in tax practice. You've always got to consider those. you need to go through the considerations of all of the major types of entities. Right now, at the time of this video, the big three are C corporation versus S corporation versus LLC, and there are advantages and disadvantages of being one over the other types. And we have to instruct our clients on those different advantages and disadvantages. Now, it might be clear for certain types of practices and facts and circumstances, and based on facts and circumstances, what entity is clearer for others, but many times that's not the case, and it just depends on future what's going to go on, what capital funding, financing, liquidation, these types of things, okay? It's tough. It really is tough, and you got to make sure that you disclose everything for malpractice reasons. And one thing else I want to mention is before the Tax Cuts and Jobs Act of 2017, it was a lot easier to do choice of entity. It was still difficult. There were still times where it made sense to be a C corporation, S corporation, LLC. But after Tax Cuts and Jobs Act, it's become even more difficult because you have the lowering of the C corporation rate. You've got this qualified business income deduction that becomes more facts and circumstances because some types of entities, as you saw, some types of businesses like specified service trader businesses, they pretty much don't get the benefit, especially if you're dealing with a case where, like situation 6, where, situation 3, where the owners of the specified service trader business, they are above the taxable income amounts, right? Situation 6, you have a qualified trader business where you're above the amounts. That can be fine with managing the qualified wages and the qualified property, those requirements, and making sure that your numbers work out. Which, by the way, I talk about that in the planning video or planning discussion in a moment. But just keep that in mind, right? It's become more fact intensive, right? Because if you're a specified service trader business, then the QB, and you're going to plan on making a lot of money, you're probably not going to get that qualified business income deduction anyways. You might have some loss years, so that might be something that might affect. But if you plan on making money in the future, which most businesses do, then you got to take that into account. All right, let's go ahead. Let's jump into the business entity choice and the QBID planning. I should say the business entity choice is within the QBID planning, but keep that in mind. All right, so I hope you enjoy that.